Hello, it's Jonathan Wellham of Rocklinc Investment Partners, and it's November the 1st, 2018. And we have just had a very exciting month in October, and so I thought it would be a great time to give our clients a quick update. Now, on the slides that I'm going to go through quickly this morning, you'll find a disclaimer slide, and that's very important in terms of keeping track with all of the legalese. And on the next slide, you'll find that there's a video update slide and just sort of the three areas that we want to look at today. First of all, current market update. Second, interest rates continue to edge higher. And third, areas of opportunity, how we're responding to the current market conditions. You'll note on that first point that last month, the month of October, was the worst month in 7 years for the TSX. That's the Canadian index. So it was a little bit choppy, but as most of our investors know, that's also very opportunistic for us as long-term investors. So on the next slide, in fact, on the next two slides, you're going to have some material that summarizes some of the things that took place last month in terms of October 2018. So on that slide, you'll see that in Canada, the TSX, I'm just going through some of the indexes just to give you a quick overview of the changes that took place last month. In Canada, you see last month the market was down by about 6%. And we'll just stay in that one column there, October 2018. You'll see that the S&P 500, which would be the very large US-based companies, global companies, was also down 6%. The NASDAQ, which is technology laden, so very heavily technology oriented, was actually down 9%. And you might have heard about that if you're reading the press, that the technology companies came off quite a bit. And then the FTSE, the UK market in London, was down 6%, and then the DAX market, the German market, which is a very substantial market in Europe, was down about 7%. So it was a down month, to say the least. Now, if you just move over on that same slide to year to date, you can find out then that what's happened sort of year to date. You can basically see that most of the drop in October has taken out the returns sort of year to date for most of the markets. And we'll look at the next slide in a second there, but you can see that the TSX in Canada year to date is now down 7%. The US markets are slightly up year to date. The S&P 500 is up about 2%, and the NASDAQ, which has done very well this year, is still up by about 6%. And then the UK market and the German market are both down fairly substantially. In fact, in Europe, the markets over there are down double-digit year to date, generally speaking. And then on the next slide, we just talk about some of the other international markets. You might have heard about the Chinese market being beaten up quite a bit this year. It was down 7% in October, but it's actually down over 21% year to date. The Hong Kong, the Hang Seng market, which has a lot of international companies on it, down 10% last month and about 16% year to date. And Japan also has given up all its returns and more so far this year. Oil was really hit hard last month, and I've just put last month's number there, down 10%. And gold was probably one of the only assets that was up last month, which should be expected because it's a bit of a hedge. It was up a couple percent. It's up a lot today. We'll see if that holds. I think gold and silver are very cheap, and we could see quite the run on those, and we've got some exposure to the finance companies in that area. We'll talk about that in a second. Overall, on average, and this is going to vary by client, we were off about 3% last month. And that's a average across client accounts. Some accounts would have been down less than that, others slightly more than that, but basically a little bit less than half the market, which makes sense given our cash weightings, our bond weightings, and also just sort of the nature of our particular portfolios. And then year to date, we're largely flat across most of our accounts. So hanging in there. We hate to give up any ground, but if we give up a lot less ground than the market, that's good, and it also provides opportunity for us to dollar cost average and pick away stocks that have really come off and provide greater opportunities for our clients. On the next slide, we just point out that interest rates continue to edge higher, and that is important. As interest rates come up, and if they continue to edge up, it will put pressure on bonds. I mean, bond prices come down if interest rates go up, and also stocks. It will continue to put price pressure on stocks. So we're being very conservative, very careful. If the Federal Reserve and the various central banks continue to push interest rates up, we think that this will cause the stock market to have more headwinds, and it'll be a little trickier to go forward, and that will also provide us opportunities to pick off some of our favorite stocks at great prices. I've just noted here that in the month of October, the 10-year Canadian bond and also the 10-year U.S. Treasury bond were up 5 basis points and 8 basis points. And over the last 12 months, 52 basis points and 76 basis points. So that's 0.5%, 0.52% for the Canadian 10-year and 0.76% for the U.S. Now, why is that important? Look, if interest rates are going up, it's going to make it tougher for capital values to increase. It'll also put pressure on our economies, debt financing. Housing prices should be a little sloppier, maybe harder for them to go up, and so on. So to me, that means we want to be careful. There's going to be some opportunities coming our way. And then on the next slide, just in terms of areas of opportunities, all of the companies so far that we own in the third quarter have performed quite well. We've had really very little disappointment in terms of the performance of the companies, and I'm speaking here their financial performance, not the performance on the stock market, but financial performance. Companies are doing well, which is much more important than the stock price long term, and so that's good. The precious metals, as I mentioned before, are very inexpensive, and we continue to look for opportunities there. And the royalty companies which we own continue to do deals, and they also continue to make lots of money, which is important, and they are generally quite inexpensive, a number of them very inexpensive. And then large dividend paying stocks are also quite inexpensive. When interest rates come up, it tends to dampen the value of infrastructure companies, real estate companies, and so on. And so this provides opportunities to buy these companies at cheaper prices and get great dividend yields. And so I've got examples there. Brookfield Infrastructure, Brookfield Renewable is now giving over 7% dividend yield. TransAlta Renewable, it's close to 9% dividend yield on a relatively conservative company. Choice Properties, First Capital. There's other companies that we own that are quite conservative, and yet they have come off in value because interest rates have come up. And that's more a short-term phenomena, and it also gives us opportunity to buy great companies and increase dividend yields in your portfolios, which all of our investors are quite interested in. We continue to nibble away at some of our favorite technology companies, given that sector has been hit hard, and there's a number of companies we like in that space, and we're going to take advantage of that. And then we're actively looking at a whole host of new companies, new opportunities as we ferret out more stocks and businesses to own for the long term. So it was a tough month in October, and that's fine. That's what happens on the stock market. And we continue to look at the medium to longer term and take advantage of the volatility, and are thankful that we've got cash and short-term securities in your portfolios that we can use to, again, dollar cost average and take advantage of the better prices going forward. So there's a quick update. The last slide there, just a quick reminder that we expect the best, plan for the worst, and prepare to be surprised. We continue to invest in quality and value and we'll continue, again, to be very disciplined in our approach to investing. If you have any questions, email, call, stop by the office, and we'll look forward to giving you another update in a few weeks, and we'll see what happens in November. Thank you very much, and have a great day. Bye now.